Security Analysis and Portfolio Management. Unit 1, Part 3. In this part, we will study investment, speculation, gambling, difference between investment and speculation, difference between investment and gambling, and investment avenues. So, first, the difference between investment and speculation. First, as you know, what do you mean by investment? Investment means it is a commitment of a person to derive future income in the form of interest, dividend, or appreciation in the value of the capital. So, investment means to derive future income in the form of interest, dividend, or appreciation in the value of capital. And speculation means taking business risk with an anticipation of acquiring short-term gain. It also involves the practice of buying and selling securities in order to profit from the price fluctuations. So now, after knowing the meaning, we will go through the difference between investment and speculation. The first point of difference is time horizon. For investment, it has a long planning horizon. His holding period is usually one of more than one. And in speculation has a very short planning horizon as it involves few days or few months. Next one is risk. As in investment, assume moderate risk with moderate return, means there is risk also, there is that much return also, but in speculation there is high risk with expectation of high return. Then the third one is decision. In investment, scientific analysis of intrinsic worth of the securities, means decisions are taken on the basis of intrinsic worth of the securities for making investment. Speculation for decision. We take insider information, market psychology makes greater significance, means inside information we have to consider and then make the decision. Fourth one is in investment the person uses his own fund, but in speculation he uses his own fund as well as borrowed fund. Fifth one is returns. So in investment there is good rate of return, means normal rate of return, but in speculation there is huge return as well as huge risk. Sixth one is income. In investment there is stable income, but in speculation there is uncertain and erratic return, means there can be profit or losses. Seventh one is behavior of participants. Investment there is conservative and cautious. They are cautious about making investment, but in speculation they are daring and careless. So because there is more risk, so they are daring, that they speculate. These all are the difference between investment and speculation. Next we will study difference between investment and gambling. Investment, first investment, the point is planning horizon. In investment there is longer planning horizon, but in gambling there is short planning horizon. Second basis is basics of decisions. Investment. In investment, scientific analysis of intrinsic worth of securities, but in gambling they are based on tips and rumors, what the people say. Based on that they take decisions. Third one is nature. In investment they plan the activity and then make investment, but in gambling it is unplanned activity. Fourth one is risk. In investment, there is commercial risk. In gambling, there is artificial risk. Fifth one, returns. In investment, they have only positive returns. They expect positive returns. But in gambling, there may be profit and there may be loss. So, negative returns are also expected in gambling. Then, sixth one is motive. In investment, safety of principal and stability of return means investment is done because of safety of their principal amount which they have. And in gambling, motive is to have entertainment with earning. Seventh point is income. In investment, the primary motive is to make income, but in gambling, it is secondary motive. For primary motive is to get entertainment. Next, we will study investment avenues. Investment avenues are the different ways that a person can invest his money. It is also called as investment alternatives or investment scheme. In this, we have two that are negotiable investments and non-negotiable investments. So first we will study negotiable investments. So negotiable investment is divided into two parts, that is variable income security, fixed income security. Variable income security means like equity shares. Equity shares are commonly referred as common stock or ordinary shares. The most common classification under these shares are: first one is large capital, mid capital and small capital stock. So the large capital stock are shares of high market capitalization. The small cap ones have a low market capitalization and mid cap ones fall in between these two. Blue chip shares. The shares of companies which have a consistent track record and are doing exceedingly well compared with other companies are known as blue chip shares. For example, Reliance, SBI, ICICI, HDFC, ONGC, Infosys, TCS, Wipro, HLL, ITC, Tata Steel and Jindal Steel. These are the companies whose shares are named as blue chip shares. Next is growth shares. Stock that have a higher rate of growth in profitability than the industry growth rate are referred to as growth shares. Next, D. Income shares. These stocks belong to companies that have stable operations and pay regular dividend. The companies which pay regular dividend, they are known as income shares. E. Defensive shares. Defensive stocks are relatively unaffected by market movements. For example, a host of pharmaceuticals stocks posted returns even in the period of market slowdown. F. Cyclical shares. The upward and downward movement of the business cycle affects the business prospectus of certain companies and their stock price. Such shares provide low to moderate current yield. For example, automobile sector stocks are affected by the business cycle. Next is speculative shares. Shares that have a lot of speculative trading in terms of referred to as speculative shares. Next is fixed income securities. Fixed income shares or securities are categorized as follows. First one is preference shares. The biggest advantage is the tax exempt status of the preference shares dividend. B. Debentures. Debentures are generally issued by the private sector companies as a long-term promissory notes for raising loan capital. The company promises to pay interest and principal as stipulated, whereas is a long-term debt instrument that promises to pay a fixed annual sum as interest for a specific period of time. Public sector companies and financial institutions issue bonds. Third one is government securities. The securities issued by the central government, state government, and quasi government agencies are known as government securities or gilt edged securities. It is a secure financial instrument which guarantees the income and capital. D. Money market securities. So as you know, money market means where short term trading is done. So money market securities, these have a short term maturity, say less than a year. Common money market instruments are treasury bills, commercial paper, and certificate of deposit. First one is treasury bills. It is fundamentally an instrument of short term borrowing by the government of India to help the cash management requirements of various segments of the economy. Generally, treasury bills are of 91 days. Since the interest rates offered on treasury bills are low, individuals very invest in them. Second one is commercial papers. It is a short-term negotiable instrument with a fixed maturity period. It is an unsecured promissory note issued by the company either directly or through banks. Next is certificate of deposit. It is a marketable receipt of funds deposited in a bank for a fixed period of a specified rate of interest. Next, non-negotiable instrument. Till now we studied negotiable instruments. Now we will study non-negotiable instruments. In this, first one, deposits. A. Bank deposit. The bank offers current accounts, saving account, and fixed deposit accounts with a fixed rate of return. B. NBFC, non-banking financial companies. It is one of the financial intermediate company which comes under the purview of RBI. Security of the deposits with the NBFCs is lower than of the deposits with bank. These two are the types of deposit. Next, postal savings. Postal savings like National Savings Certificate, Kisan Vikas Patra, Monthly Income Scheme, Senior Citizen Scheme, PPF are considered as reliable form of investment because they are backed by the government of India under Indian Postal Department. Postal savings scheme offered to lower middle class and lower class investors. But now middle income and higher income groups are also considering this avenue with the increase in the uncertainties. Next is life insurance. It is contract for payment of a sum of money to the person assured on the happening of the event insured against. The core feature of the is protection and elimination of risks. Insurance emerges as a combination of both investment and assurance. The major advantage it includes are protection, easy payment, liquidity, and tax relief. In this we have unit linked insurance plan. This is a market linked insurance plan. It provides life insurance combined with savings at market linked returns. The premiums is mainly invested in risk free securities like government securities and fixed income securities. Next one is real assets like gold, silver, art, antiques, real estate. These all are the real assets in which we can make investment. So these all are the investment avenues where you can use your money or invest your money to get income. Thank you.